This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Need help in finding investors for your startup, fund, or angel group? 10 Capital provides funding as a service helping you find accredited investors. Contact 10 Capital to gain access to investors for angel and venture capital funds, family office rounds, and syndication raises. To learn more, go to 10capital.group. Hello, this is Hall Martin with Investor Connect. Today we're here with Riley Oickle, owner and CEO of Riley Oickle Investments. Investing in real estate can be a stressful endeavor. Without systems and processes in place, chaos can set in quickly and money can be lost. For those of you that are ready to do your first investment deal but are fearful of the unknown, a joint venture is a fantastic option. Becoming a joint venture partner with Riley Oickle Real Estate Investor is a great opportunity to get an understanding of real estate investing while also owning equity in a property. Riley, thank you for joining us.
Yeah, thanks, Hall. Appreciate you having me on here.
Great. So what was your background before investing in real estate?
My background, like work-wise, was actually coming from a franchising company. So I was a part of a student-run organization. It was called Student Works. And I actually ran a window cleaning business there. So it was a home maintenance company for a couple of years. And then I became a coach with them. So I was actually mentoring other students how to do that. So I'd go across campuses in Canada here. And I'd be going in to find like the kind of brightest entrepreneurial students, and I'd enroll them in being quote unquote kind of a franchise owner, and I'd be their coach during that process.
Well, that's great. So what excites you right now?
What excites me right now? I'm pretty excited about the idea of doing environmental properties. So like very, very green properties. We're looking to put some solar panels on properties or geothermal heating, and that would be pretty exciting. We're doing a few pre-fabricated properties right now that are going to be Airbnb properties, and we're making them pretty green. So that'll be really cool.
So what's your advice for people investing in real estate? What do you tell them to do before they write that check?
What do I tell them to do before they write the check? I usually tell them, I think the biggest thing overall is going to be ensuring that during the analysis process, you're taking your emotions out of it. I always like to say 90% numbers, 10% intuition. And, when you're becoming emotionally attached to like an investment property, usually can go pretty badly. I've had that happen time to time. And so now it's purely analytical. The calculation is very cold. When you're buying a home, that's a completely different decision-making process. That's an emotional decision-making process. When you're buying an investment property, it's purely analytical. So make sure you stick to your numbers, that you have really great metrics or key performance indicators that are usually percentages that need to be met before you accept a property in your portfolio. And never sway away from that either. Like just stick to your guns, because as soon as your standards, lower, then your entire investment probably won't go that well. So that would be my piece of advice.
Great. Well, so how do you see the industry evolving from here? We're coming out of COVID. Real estate is rocketing ever upwards. Where do you see it going?
Where do I see it going? I believe that right now, like the interest rates are quite low, especially in Canada. We're at like 1.5 to like 2%. And it's very, very low. I can't imagine it going any lower. It's essentially free money right now. And yeah, so I do believe interest rates are going to rise. And when they rise, the people that are in a variable rate mortgage are going to be kind of left high and dry potentially if the cash flow is like barely breaking neutral. So ensuring that you have a really great cash flow amount there in your property is number one. And then that you're in a fixed mortgage would be number two. But yeah, I think a lot of people are going to be left high and dry when interest rates do increase. And I think the price of housing is going to kind of plateau here in the next year or two, if not even decline, maybe a couple percent, 5, maybe even 10%. I think we're seeing unrealistic appreciation numbers right now.
Absolutely. So, what do you think is the biggest change we'll see in, say, the next 12 months?
Biggest change: interest rates increasing. Yeah, I don't know if the price of housing will decrease that quickly, but it will at least plateau. I do believe the kind of floodgates are opening again with the amount of listings available. Whereas before, like during COVID, like very few people were listing their home. So the supply and demand, it was like very, very high demand, but low supply. And now the supply is starting to open back up. So more and more properties are available. So prices will kind of plateau a bit. And then interest rates will most likely increase.
Great. Let's talk about your investment thesis and what exactly you invest in and what your criteria is. What exactly do you look for to make an investment?
Yeah, that's a good question. So we always use the joint venturing strategy and the burger strategy. So from an ROI perspective, there are two criteria that we look for would be the first being a 10% cash on cash ROI. So a property needs to have at least 10% cash on cash for the ROI there. That's essentially the annual cash flow divided by the initial investment amount. And then the second kind of metric that we use would be a 25% total ROI. So 25% total ROI, that's when you add the cash flow ROI with the equity ROI and the appreciation ROI. And why we do 25% is when we're joint venturing with people, you kind of have to think of it where they're putting in all the money. And so that's 25% total ROI for the business for that property, but that's split in half. So they're getting 12.5%, and then I'm getting 12.5%. All right. So that would be kind of the thesis there of like what we look for. I guess using the BRRRR strategy too requires us to find discounted properties that are distressed. So that's important.
And so any other criteria that makes or breaks a deal for you?
I always like to invest in cities that are over 50,000 people, that are considered to be value markets, not vanity markets. Like a vanity market would be like Paris or New York, even Toronto, where I live here. So I don't invest in vanity markets because you're paying a premium for a brand. Value markets are like areas that, you know, the 13-year-old girl doesn't dream of like living in when she's older, you know, and it's somewhere that, you know, is just like low key, but those are usually where the value is. Those would be areas that I'd like to invest in. Yeah.
Well, great. Well, so what are the challenges in investing in real estate that you see investors struggle with out there?
Yeah, I think at the very beginning, like I help people to buy their first property. And so I do tend to find that the people that are at the beginning stages tend to be in this like shiny object syndrome mode. Like they're all over the place and they're not focused and they're in paralysis analysis. They're feeling stuck. And I believe that the number one reason why they're doing that is because they don't understand like how to kind of learn. They're just learning everything. And the industry goes so deep with knowledge that it's so difficult to get anything done when you're just focused on 10 different cities and 3 different strategies and 4 different property types. So you need to get very focused on one city, get really good at that city, use one strategy, get super good and familiar with that one strategy, and pick a type of property. So usually my students work with, they're doing joint venturing, the BRRRR strategy, 2 to 4 unit buildings in kind of like a value market. So get crystal clear, get focused, and that's where you're going to get traction. Also, like ensure that you're actually listening to content that is relevant to you, or taking in content that's relevant. So you don't have to learn about RRSP investing or like investing through different methods if you don't need it. So pick one, stick to it, do it a few times, get good at it, and then you can kind of iterate off of that. But I think a lot of people are really expanding the call it like the runway that it will take for them to buy their first property because they're just all over the place. But you can really condense that timeline when you get focused on one specific kind of one specific investment type and city.
Well, there are many types of real estate and different types of applications out there. If you had to pick one or two that you think are good immediate opportunities for investors, what would you put at the top of the list?
I would put multifamily residential properties being a 2 to 4 unit building. And I would also use the BRRRR strategy and joint venturing. So the exact same method I'm using today. So that's like the long-term, the 10, 20, 30-year play. And then the secondary one would be Airbnb properties. So single family properties that are 4 to 6 bedrooms. And that really gives me the cash flow there to play with so that the banks will give me additional mortgages based off the cash flow of the portfolio. So the Airbnbs are cash cows. It's not an equity or appreciation play. It's purely the cash flow of the portfolio. And then the long-term be your residential 2 to 4 unit buildings. And I like to partner with people that can do 5 or even 10% down for an owner occupied situation. And then we're investing little bits of money into the portfolio versus like doing 20 or even 40% when you're going into commercial.
Great. And what other properties might be a good target these days out there, given the post-pandemic, people are moving away from the big cities, moving everywhere. How do you see that impacting the real estate market?
Yeah, that's a really good question too. I do believe that right now, now more than ever, people are going to like want to live in a more rural place. Like they're gravitating away from urban centers, and they've realized that people can work remote. Like more and more individuals are working remotely, so that's going to be something to focus on as more rural areas. Does that answer your question, Paul?
Yes, it seems like there's a shift in work patterns. Some people can work remote, and it appears that they may want a larger space because your home is not only the place you live, it's also your office, your gym, your classroom for your children, and so you need more space for it. And of course, you can be anywhere at that point. It didn't have to be downtown Manhattan or the Bay Area. It could be just about any other place where there's different climates and different amenities as well. How do you see that impacting the real estate market in the coming few months?
Yeah, I do suspect that people that are owning long-term rental properties in markets where like you mentioned Manhattan, like you're somewhere downtown, you're centralized, even in Toronto here where I live, like, and the rents are at an all-time premium. Like, these are one bedroom places for $2,000, even $3,000 a month. If the economy were to come down a bit, or if the demand were to decrease in these urban centers where prices for the one bedroom are like really, really high at the premium level, those are the units, or those are the properties that are going to take a hit first and foremost. So that's how I do believe that when the supply when the demand decreases, when people are moving away from the urban centers, that's what's going to affect like these more premium units being decreased. Mm-hmm. So unfortunately, for me, I've never wanted to go after these premium units. Yes, you can make a ton in cash flow when you're charging like $2,000-3,000 for a one bedroom in downtown Manhattan, let's say. Mm-hmm. But when you're at the kind of the middle of the tier to the bottom of the tier, and you're charging $1,000 for a one bedroom, when minimum wage is $14 an hour, something like in Canada, or if it's like whatever it is there in Austin, Texas right now, like, you always want to stay in the units that even at the minimum wage rate, like people can still afford to pay their rent. It's when you're in the $2,000-3,000 a month that people can't afford to pay that rent alongside of their food and their travel costs and everything else that comes with it. You want to make sure that people can always pay the rent. And, I don't believe that that's going to pan out too well here if the economy were to come down a bit after COVID and people are moving away from urban centers. Yeah. So that's how I think it's going to be impacted.
Cool. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I think at the end of the day, if anyone's interested in getting started, ensure you kind of take some of this advice that we're talking about today and put on your blinders, ensure that you're just focused on exactly what you need to know in kind of chronological order, and that you're not indulging in info overload and saturation of knowledge. So just focus on exactly what you need to know. Reach out to people that have done it before. That's what I did, when I started at the very beginning, grabbing 15-20 minute phone calls here and there. Mm-hmm. And just connecting with people that are already doing it. If someone's interested in kind of doing a program that's formalized, like I've put together a program to help people get the result of their first income property, and we work with them until we get them there. So if that interests anyone, feel free to reach out. But that would be the gist for now.
Great. So how best for listeners to get back in touch with you?
They can reach out on my website there. So you can go to www.RileyOickle.com. So I'm sure that might be in the show notes there. And you can reach out there on my website. Just hit the contact button and schedule a call. And I'd love to connect and help you if I can. Yeah.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
All right. Thanks so much, Alan. Appreciate it.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.